Yeah, you are. You know, I've often said I have no idea how so many of us reached puberty and got to the age we are. We rode bicycles with no helmets. We didn't have seatbelts in cars. We roller skated in the street, no less, with no arm pads, shoulder pads, knee pads. We had, of all things, BB guns. You know, all of this kind of stuff. And it just, you know, when you look back, and I've said this, Mary Thomas and I had a very dear friend. Mary Thomas is my wife. In the South, every lady has a double name. And my wife was named for her grandmother and her father. So that's how she got the name. But we had a dear friend, and we always called, his name was Hubert, we called him Smiley. He always smiled. He had the most wonderful disposition. You were around him 5 minutes and you felt better. That's the type of person he was. And he had a hard life. He grew up during the Depression. He was in a CCC camp and all of that. But just a great guy. And he had one grandchild, a little girl. And she was 6 years old, and we were at our Kiwanis Club family picnic. And that day was Hubert's 80th birthday. And his little granddaughter ran up to him when her parents brought her in, and she was so excited. And she looked up at him, and she said, "Granddaddy, how old are you today?" And Hubert looked down at her, and I can visualize him right now with that wonderful smile he had. And he said, "Darling, today your granddaddy is 80 years old." And she was quiet. And she looked down at the ground, and she looked up at the sky. And then this big smile came on her face. And with excitement as a child would have, she looked up at me and she said, "You know what's so, Granddaddy?" And he looked down at her and he said, "What, darling?" And she looked up at him and she said, "You're not going to be around much longer." True story. And he laughed and laughed about that, and he lived to be 95. So she was out of high school, in college when he died. Turn, please, to page 1214. How do we handle capital gains and losses? The very same way that we do for regular tax, except for here, we're only dealing with those gains and losses that are in fact net investment income. When we offset our gains with losses, we can only bring the losses down to zero, even though we may have up to $3,000 deduction in the 1040. Now, there is a reason for this. The reason is, in the code, in the bill, when this was passed, it made reference to capital gains. And it said you will, net capital gains will be in the tax base. And they omitted the word losses. So the IRS originally interpreted that to mean that you could never use the capital loss deduction. You could only bring the gains with offsetting losses to zero. When the final regs came out, they retained that part of the calculation. So when we are working with this, we will have gains, we may have losses, but we can never have a net capital loss. Only be brought to zero. Now, that makes our case study wrong, but we're going to correct it. Very easy to correct. Because in the final regs, they said any capital loss deduction that we have can be used to offset other investment income. Now, it's just one of those quirks. It would be so much simpler to let it reduce the gains and up to $3,000, and have it go that way. But because of the way the bill was written, they can't do it. So what they're saying is, okay, we'll bring those gains to zero, but if we have a net capital loss up to $3,000, we will now use that to offset other income. So let's look at the case study on page 1215 and strike through where it says 1250 depreciation recapture. I didn't cover that because that was the IRS's a proposed reg that allowed us to use up to $3,000. But that's out now. Here's George. George has a $40,000 capital loss and a $10,000 capital gain. So he's got a net loss for the year of $30,000. He has $5,000 of income from dividends and interest. Now he can deduct the $3,000 against other income for regular purposes. We know that. And he has a $27,000 carryover. Now, look at where the second paragraph. For NII purposes, the $10,000 gain is offset by the loss. However, George cannot reduce his dividend and interest income by the allowable. Strike the word however, or you can leave it there and just take out the word not. So it reads, however, George can reduce his dividends and interest income by his allowable $3,000 loss. Therefore, he has $2,000 of NII. So that's the final reg. And strike through the third paragraph, and you should have it correct. It should be 2. Remember, he has $5,000 of dividends and interest, but he has a $3,000 capital loss, and now they're saying he can offset that $5,000 of dividend and interest with the 3. So that brings it from 5 down to 2. Yeah, make the 2 corrections. Now you get the same answer if you had a $3,000 capital loss and $5,000, you're offsetting it. But it's just the mechanics of how they do it. And it's because of the way the law is written. Now, page 16 and 17. What they told us originally was extremely complicated. Now, there was no question if one held an interest in a partnership or S and one did not materially participate, then 100% of the gain is subject to NII, and that is still the rule. But where you have an accounting practice or a trade or business and you materially participate, the general rule, which is still there, is extremely complicated. Because I told you when we get the K1 for regular purposes, we have each and every item going into the 1040. But for NII purposes, we have to look at each and every item to see if it gives rise to a trade or business, and we could exclude that under the trade or business exception. But if we had dividends and interest, that would go into the base. Now, the general rule when we sell our interest in our S or partnership, or we liquidate them is the very same thing. That gain will be excluded because we materially participated. However, if we have non-trade or business assets, stocks as an example, and we have a gain on that, that gain will be included. Now, the procedure that they gave us is extremely cumbersome. And if you will turn to page 19, here is a case of Adam and Eve in the Garden of Eden. And guys, Eve owned 75% of that thing. That's why she got us in trouble. But then Eve would say, well, Adam only deserved 25% because he didn't do anything. Adam did not materially participate. So in the example, and by the way, this was an IRS example, in this example, the $5,000 of gain from him would be NII income. Now for Eve, she had a $15,000 gain. She materially participated, and what they told us in essence was that there's a look-through rule. We've got to look through at all of the assets. And the gains on assets that are not trade or business cannot be excluded from the tax base. Now, in the example they gave us, where they had 3 assets, oh, they make it look so easy, don't they? Because this is designed by somebody that's never done a tax return. But here, they excluded it all. But let's just go back and let's assume that there was an asset in there with a $3,000 gain, and it was stock. Of her $15,000, then she could only exclude 12, and 3 would be in the tax base. Now that's very complicated. And so what they have given us now is what they call an optional simplified method. Now, first of all, the word optional scares me. Because if we use it and we're audited, the agent auditing us probably won't know about it. I had an agent come in my office one day. First of all, he made me mad because he put his feet on my desk. But then when he told me, demanded to see the retirement plan, and I informed him the client didn't have one. And he informed me they most certainly did because they took a deduction for an IRA. Didn't know the difference. Now listen to this optional simplified plan. The purpose of the simplified concept is where the amount of gain from a non-business asset is very, very small. You'd bought 100 shares of stock in something, you're selling out or you're liquidating your practice, you got an overall gain of $50,000 and the gain on this is $600. That's what they're talking about. Now, while they do not give us full details, they tell us that those will be forthcoming. They didn't tell us what year. But here's the deal. A transfer, that is, if you are selling and you have a recognized gain on the sale and the gain does not exceed $250,000, we will be able to use the simplified method. Now, the other user is where the gain does not exceed $5 million. But here it's where the seller's historical historic share of income. And that's for the current year and the prior to, where there are items of all income, gain, loss, deduction that they took into account in calculating the NII is 5% or less of the total amount allocated. So what we're saying is, sale price goes up to the gain goes up to $5 million. You look at your allocation of gain, and 5% or less than 5 is allocated to the NII. You can use the simplified method. And they were telling us that they're going to give us some references and examples on that. The regs, the final regs, contain very few examples. Their idea, I think, was to get the final regs out before the end of December. So, last thing, turn over to page 21. I told you at the very beginning there are two types of allocable expenses. One of them is the direct, such as our rental expenses. The other are our itemized deductions that are indirect. And there are three of those, and you saw them. If you looked on the 8960, they comprise part 2. And they would include investment interest, investment expenses, and an allocable share of income tax, state income tax. Now, we give you a case study with the formulas on page 23. And here is an individual with $2 million in W-2, $400,000 in AGI. $400,000 in interest, $2 million in AGI, 1.6 in wages, 400 in interest, $2 million AGI. Clearly above the $200,000 if he's single. He had investment expenses of $70, unreimbursed employee business expenses of $30, investment interest of $80, and state income tax of $120. If you'll turn the page, we have a table there. And I'll go through and I'll tell you any difference under the final regs. This case, as it is written, falls under will still apply, I believe, under the final regs, but there could be something you need to know, and I'll explain that. We have a $400,000 net investment income. We have investment interest of $80. Now remember, first of all, that is not subject to the 3% phase out. And that's important to remember because it's already limited. So we will get the $80,000. Drop down to your income tax. They gave no examples in the proposed or final regs as to how this allocation would be made. They only said you may use any reasonable method. Now, the way I do it is I do the return with, and I do it without whatever the item is. Because in my state, everything is taxed at the same rates. We have graduated rates, but we don't have a special tax on capital gains and so on. And obviously, the difference in it before and after would be the tax associated. So you might be able to use that method. You might have to work out a little worksheet on it. But whatever happens, remember that tax is subject to the phase out. So we started out with $120,000 of tax, but when we calculate how much of it is allocable to investment, we find it's $24,000. That is phased out. So we end up with a $17,000 deduction. Now look above that at your investment expenses. We have here $70,000. But notice there is a 2% reduction. That gets it down to $42,000. And that's provided for in the final regs. Now, the 2% items are also reduced by 3%. So we end up with a deduction of only $29,750. When we go to the form, Part 1, we fill in all of the income items. They are pulled directly from the face of a return. But look down at Part 2. We have our investment interest, state income, and miscellaneous investment expenses. And they total $126,750, giving us a tax base of $273,250. The tax on that is at $10,384. Turn the page and you will see goes on line 60. Line 60. Now, where you're going to have to do special study when the instructions come out, or the handling of any 2% reduced items, look to see if they give any direction or examples on the state income tax. And also, if your client does dispose of an activity in which they materially participate, look at how the examples work for your simplified method. Now, truly, I think this is going to be, I kind of looked at 2013 doing the taxes, and you know what I thought of? I wonder how they felt when the Revenue Act of 1913 passed. It didn't cover that many. I saw, and I cannot remember the number of pages, but I have seen the original CCH explanation, and it was like 36 pages long. I teach Sunday school sometimes, and I was studying for a lesson, and I love trivia. And I found this piece of trivia. It said that the number of words in the Internal Revenue Code of '86 as amended, now this was before the Affordable Care Act, and the number of words in the regulations explaining the code were equal to the number of words in 39 copies of the King James Version of the Bible. And I immediately prayed and said, "Thank you, Lord, for giving the 10 Commandments to Moses and not the IRS." We would have regulations, we would have Rev Procs, we would have revenue rulings. It would never end. By now, we would be up to 135,000 commandments if they had gotten hold of it. But that's how complicated this really is. And you know what bothers me is that the average individual on the street, the one that comes in, they bring in their information, we do the return, it is neat looking, it's printed, it's done on the computer, and they think, oh, there's nothing to this. They don't understand that it's just like if you're going to the doctor, there's nothing to pulling a tooth All you got to do is grab hold of it tight enough and you can pull it out. But that doesn't mean it's comfortable. And it's the knowledge of how to do it, not what that end result is. And they just don't understand it. Probably as accountants, we haven't done a good enough job in that part of our marketing to explain to them, what they're really paying for in that service. Look how much it costs us to produce a tax return. It's not free. When you amortize your tax package over it, you might have a separate depreciation package, the time element, everything. Now, I'm far enough away from home that I can talk about my clients. I have two people in my office. The last one was hired 18 years ago. The other one, 20 years. Monica, who's been there 20 years, is German. She married a GI. And I get on to her sometimes about her German temperament because my great-great-grandmother was German, I understand. She said the other day about one of our clients, would you say this about your client? She said, you know something? He'd left the office and he'd come in about something and she said, if you hooked up a 1-watt light bulb to his brain, it wouldn't flicker. And the sad thing about it is she's probably telling the truth. But that's how, some of our clients, how we get some of our clients, in their attitude. Try to get information out of them. It's like pulling eye teeth. Turn into chapter 15. And I want us to start out at the very back of the chapter on page 1516 because it ties in to the net investment income tax to show you how this will touch so many areas of what we do. When Section 121, the exclusion of gain on your principal residence came in, let's face it, that was probably the most taxpayer-friendly provision of the code that was ever there. Except for the fact that they said when you died, you no longer had to file a tax return after the year of death. That was special. But the planning of this thing was unbelievable. At the time, I remember I had a dentist as a client. He became disabled. He was in his late 40s. I believe he was 48. And he had to sell his dental practice. Luckily, he had a brilliant accountant who explained to him the advantages of purchasing disability insurance. It wasn't me, it was my boss at the time. And anyway, he came to me and he said, we're going to sell our home, the kids are gone, it's too big, and what will be the gain? And Section 121 had just come in, hadn't been in very long. And I explained it, and he couldn't believe it. And his gain was going to be somewhere a little above $400,000. So as the time got closer, they had listed it, and he came to me, and I said, what do you plan to do? Where are you moving? And he said, well, we've got an offer right now. We don't have anything. We're thinking about going down to our beach home and staying, the rest of the summer and then buying something in the summer. And he said, we know that there's a condo down around in a cul-de-sac near us. It's also on the golf course. And we've looked at one of them. We have a friend living there. And we're thinking about buying this one that would become available. What do you think? And I said, well, I think it's the worst thing you could do. And he kind of looked strange. I said, look, you have a home at the beach. It's a beautiful home for the time being because it's 2 streets away from the high tide line. This was back before we had the snap in real estate, and beach property, vacant lots 40 feet wide, $1 million. So I said, I think you should move down there and stay at least 2 years. Make it your principal residence. And I explained. Well, he liked that idea. But they didn't stay 2 years. I think they stayed 4 or 5. And then they got an offer and they decided they would sell it. He was having a lot of problems at that time. They had a gain of over $800,000 on that thing. And the lucky purchaser now has beachfront property. Because we've been through that many hurricanes. So he was able to do what? Take a vacation home, convert it into a principal residence, sell it, and they excluded $500,000 on that and 400 and some thousand on the other one 4 or 5 years before that. Nearly $1 million in gain they paid no. This was unbelievable. And Congress finally figured it out. And so in 2008, they put in this provision called non-qualified use of the property. Now notice how I worded that. The law actually refers to non-qualified use of the property used as a principal residence. And what they said was that if you have any property and you convert it to a principal residence, if that conversion is after 12/31/08 and you have non-qualified use before the conversion, such as it was a vacation home like my dentist, and that non-qualified use occurred after 12/31/08, that gain will not be excluded. And they give us a very straightforward method of doing it. It makes no difference when the appreciation occurred. Everything is straight lined. Now, on that, my wife and I bought a vacation, or a retirement home actually, in October of 2007. And I told her, I said, you know, this is great. It's 39 miles from where we were living. I said, we can come and go on the weekends. It's a resort area. It's very nice. We call it a different world from where we live. And then I said, when the time comes and we have to sell it, we'll exclude the gain. Well, we haven't moved in it yet as a principal residence. It's still a weekend and vacation home. And so we have non-qualified use. We're not going to get all of the gain. Now, the IRS has made it even tougher because the bill referred to non-qualified use of the property. There doesn't even have to be a residence on it. You have a client and they buy a lot. It could be at the beach or anywhere else. There's nothing on it. They plan to retire and they gonna build a retirement home. In our case, I remember when they opened a new housing area, and a lot of the younger couples wanted to be in it because it was supposed to be very exclusive, but they couldn't buy the houses that were being built. And the developer made the mistake of selling vacant lots. I couldn't believe he was doing this. But he did, and they'd buy a vacant lot and finance it, and they'd take 7 to 10 years to pay for it. They have non-qualified use of the property. They may buy it today and not build on it for 4 or 5 years, but from the date of acquisition to the date that it becomes their principal residence, The IRS says they have non-qualified use. It's investment property. They picked up on that because the law said the property doesn't have to have a home on it. So this is a pretty tough thing. And let me show you how it works. If you'll go over to page 1519, and we've thrown quite a few things into this case to complicate it, because each and every one of the complications for you will be a learning item. Or it will reinforce your memory on it. On January the 1st of 2008, a taxpayer acquired a condominium in a like-kind exchange. Now, first of all, your home is not like-kind property. You can't exchange it because it doesn't qualify. But here you can acquire property, and then if you maintain its use for, quote, a reasonable period of time, as rental, investment, or whatever, the definition for like-kind property, you'll be okay. We now know how long, and I'll get to that in a few minutes because it's in the bill that created this. Now, the basis in this condo was $200,000. Acquired on January the 1st of 2008, and they rented it for all of 2008 and 2009. Now, I want to know what tax package the accountant was using to get $50,000 of depreciation. So, we're going to leave it at that. Rented it for 2 years. Then on January the 1st of 10, moved in and established this home as a principal residence and lived there for 10, 11, and 12. Selling the residence on January the 1st of 2013. The gain was $525,000. Now, just a word about this non-qualifying use period. It can only occur prior to the establishment of the home as a principal residence. Afterwards, you move out of a principal residence. That is not a period of non-qualified use. You may rent it. And the reason is very simple. We know that once it's no longer your principal residence, you've got to do something within 3 years to meet the 2 out of 5 year rule. So they said, okay, since you've got to do that anyway, we'll just let this go. So now you could rent it, you could use it for a vacation home, you could lock it up, whatever you wanted to do. That is not non-qualified use. And the gain attributable to that, unless it's attributable to depreciation, is subject to the exclusion. But look what happens here. First, he rented it. The rental took place after May the 6th of 97, and he took depreciation. And under the original bill for 121, the only gain not subject to the exclusion was the gain attributable to post May 6, 97 depreciation. So that $50,000 will never be excludable. It's taxed. Now it will also be taxed under the NII if they meet the threshold levels. That leaves $475,000 of gain subject to the exclusion. He rented it for 2 years, but one of those years was a non-qualifying year. 2008, the law was not in place, started 1/1/2009, he had 1 out of 5 years that it was non-qualifying. Straight line, 20% of that $475 or $95,000 cannot be excluded. We now have a gain of $145,000, not excludable, thus subject to the NII. But he's single. And of the $380,000 of gain, the $380,000 of gain that is subject to the exclusion, he can only exclude $250,000. Therefore, he has $275,000 of gain that will be subject to tax. And that's how you do it. Now, prior to this law, he would have only had $50,000 from the depreciation. He could have excluded $250,000, the same as here. And you would see in his case, because of the exclusion limit, you're going to get the same answer. Doesn't make it the best case. Had he been married, it would have shown a little different. But the point is, we have to be careful on these things. Now, as to the acquisition of the property through like-kind exchange. In legislation, in the bill, Congress inserted that if you acquire a property in a like-kind exchange, first it's got to be qualifying property that you can defer the gain in like-kind exchange. If you acquire it in a like-kind exchange, and then you convert it to a principal residence, first you have to use it as investment, rental, or whatever property for a, quote, reasonable period of time. But the point is, Section 121 is not applicable to the gain on that sale until you have held the property for 5 years. So someone acquiring property in a like-kind exchange that later converts it into a principal residence, they do not have the advantage of the gain exclusion until they have held the property for 5 years. If he had held it for a shorter period of time by 1 week, he would have had the full gain taxed because he acquired the property in a like-kind exchange. Turn back now and let's go to another change in law. First, from the beginning of the chapter, page 15:1. Yes? Well, I don't know. Do I know the answer? Oh, well, if I don't, for your basis property? No, not for this. For your acquisition date, the answer is yes, in terms of your gain or loss. But for the calculation of this, you have it's from the actual ownership of this particular piece of property. Now remember, if you do acquire by like-kind exchange, date basis carries over. See? But that's date basis. It's not the date basis for calculating the amount of the gain that would not be excludable here. It's actual ownership. Great point. Nobody's ever asked me that. It is important. You know, you have one question, you have one thing, and then you think about all of the other things that may be related. And what I have found, and you have too over the years, you know, within the Internal Revenue Code, there's a thin line that runs through the whole code. If you learn parts of it very well, you'll be in something entirely different, and they'll use the same concept. And it is just a thin line, as I call it, that runs through, that ties the whole thing together. And it's amazing how many of those, if you learn them and learn them well, they'll carry through to other parts of the code. Because we can never learn it all. We don't want to learn it all. They'll change it on us. All right, chapter 15, page 1. Office in the home. What a controversial item. It wasn't until, I believe, the 60s or the 70s that the IRS finally gave in on this one. And we know that you can have an office in the home under 2 conditions. First, you are self-employed. Where you are self-employed, in order to get a deduction for the office in the home, that office in the home must be a principal place of business from which you are working. It must be used on a regular basis and an exclusive basis. So it can't be a guest bedroom. Not only that, it has to be a place where you meet with clients, customers, and so on. And then a few years back, they sweetened it a little bit. They gave it a little expansion by saying, but it can also be a place where one does significant administrative work. So you might have an accounting office. You may qualify for an office in your home if you're self-employed, because at your office in your home, you bill all of your clients. You write your payrolls. You pay all of your payroll for your employees. You pay all of your firm's bills. It's theoretically possible under that scenario that you could have an office in your home. The second category of taxpayer is nearly impossible to achieve, but it is provided for. And that is where one is an employee. The IRS says this is so difficult, they don't even have a form for it. The 8829, if you look at it, can only be attached to a Schedule C or F. That's it. And if you are an employee, it will be a 2% item, and you simply have to make up a schedule that approaches the 8829. The difficulty are 2 things with the employee. First, it must be a required condition of employment. Thus, it's at the convenience of the employer. The employer's got to require you to have an office in your home. But what often trumps that and knocks it out is 280A. 280A tells us that if we rent any part of our personal residence, and it uses the term personal, not principal, so it would cover a vacation home. We use any portion of our personal residence, rent any portion of our personal residence to our employer, we are denied a deduction for office in the home.